Hello, good afternoon, everyone, and welcome to today's session of our Modesty's Mortgage Masterclass. This is session number 15. I hope you're all doing well, and I hope you're all staying safe as we prepare to ease the lockdown further by next week. So we still keep on educating ourselves every Wednesday here on Everything Mortgage and keeping ourselves updated on the latest events and latest happenings in the mortgage market and the property sector in general. I remain your person, Ikenna Umeizudike, the Director of Modesty Financial Consultants Limited based in Luton, United Kingdom. We are specialists in mortgages, financial investments, and financial advice, and we do financial consulting. So we're here for you once again, like we've always promised, and I hope you've had a good week so far. So today we're going to be continuing on the series that we've been on for the past couple of weeks, which is discussing the different types of mortgage borrowers. And last week we did talk about business partnerships and limited liability partnerships and the way they are presented as mortgage borrowers and how they can access mortgages within that structure. Today we're going to be talking about another unique type of borrower in the business borrowers category. But today we're going to focus on one type of business borrower in particular called SPV, the special purpose vehicle. A lot of you must have heard about it, but even if you haven't heard about it, today we're going to break it down. It may not be as comprehensive as you might expect it because we are constrained by time, but I bet you are going to give you the main nitty-gritty that you need to know, or the basic things that you need to know. Hi, Amara. Good afternoon. Thanks for coming on. Joy, good afternoon. Thanks for coming on. Good to have you here. So, but before then, I just want to quickly go through some of the latest mortgage updates and what's been happening in the mortgage industry, just to bring it to your notice and to your knowledge, like I've always done every week here. So, this week we've seen. Hi Patrick, good afternoon. Thanks for coming on, brother. So this week we're going to look at the figures that came out through Money Facts. Those figures told us that. Hi Patrick, thank you very much. You're very welcome. So we can see that it says that fixed rates, the interest rates on fixed rates on across different product categories has really nosedived, has really plunged. Means there has been a significant drop in interest rates across fixed rates mortgage products on average in the mortgage industry from what they were before the lockdown came into force. So pre-lockdown levels, we have seen a significant drop in fixed interest rates products across different categories of those fixed interest rates and across different loan to values. So let's get that in detail. You see, some categories have seen a higher drop than the others, and some categories on average has dropped by as much as 0.51 percentage points, from where they were prior to the lockdown measures. So the Money Facts figures shows that there has been a substantial reduction in the average rates across different tiers and loan to values on fixed rates periods. Remember, the focus is on fixed rates mortgage products, not on variable rates or another. The focus is on fixed rates products. Now, this has happened even though the availability of products has drastically reduced as well. So, these are strange times and strange things are happening really seriously. You see, product availability or the number of products available in the market are shrinking by the day, and then the interest rates on fixed mortgage products are also reducing, significantly by the day. It doesn't correlate, does it? It should be a case of fewer products, high interest rates. But then we live in very uncertain times where the base rate by the Bank of England is at its lowest, at 0.1%. Nobody knows whether it's going to go any lower. If it goes any lower, it's going to be flat zero or into negative, region. But because we're in very uncertain times. So very unusual things are happening in the mortgage market. So, but the most significant drop came within the 2-year and 5-year fixed mortgage products. Now let's look at the 5-year deals. What's happened in the 5-year deals? On average, remember this is what we are talking about. On average, it doesn't mean that every lender's product will experience this level of drop that we're talking about. It means on average, taking average of all the available mortgage products in the market. Now the 5-year fixed rate products on average saw the biggest drop across all their loan to value bands. With average rates dropping by as much as 0.46 percentage points. What do I mean by that? It means as at 2nd of June. So these figures were correct as at 2nd of June. As at 2nd of June, the average rate across all LTV bands for 5-year mortgage product is at 2.27%. But before lockdown, which was at March 13, before the lockdown, it was at 2.73%. So there's a drop on average of about 0.46 percentage points across the 5-year LTV bands products. Now, still within that 5-year fixed product, the LTV band, LTV is loan to value. The loan to value band that received the biggest drop is the 85% loan to value band. It saw the highest drop from 2.8% to 2.29%, which is about 0.51 percentage points. Okay, so that's what's within the 5-year band. Now, for 2-year deals, how has that impacted on 2-year deals? So 2-year deals, we can see average 2-year deals dropped by 0.41 percentage points. So before, this is still as at 2nd of June. So it dropped from 2.43%, which is where it was pre-lockdown, to about 2.02% as at 2nd of June 2020 across all the LTV tiers of 2-year deals. Remember, this is on average. Okay, now again, within that 2-year deal band, the loan to value category that received or that saw the biggest drop is still the 85% loan to value deal category, where the average rates dropped by as much as 0.45 percentage points. So that average rate within the 85% loan to value dropped by 0.45 percentage points. So initially it was at 2.49% before the lockdown, and now it's at 2.04% on average. And then the 90% loan to value deals also saw a little drop, a modest drop, I would say, not that little, but by 0.26 percentage points. Now on the 10-year fixed deals, it was really flat. On average, there wasn't any significant movement. In fact, it was just about 0.08 percentage points across all LTV bands in the 10-year fixed product. Okay, now talking about product availability. Remember what I said, the irony of product availability dropping and percentage points dropping, at the, interest rate dropping at the same point, and you will be thinking, how is that happening? Remember, in these uncertain times, very unusual things still happen. Now, in terms of product availability, while the rates are moving in the right direction for borrowers, because now as I'm talking, I'm sure borrowers are rubbing their palms and licking their lips and like, wow, this is delicious. This really sounds good. It really sounds good on the side of the borrowers when we talk about rates and the direction that the rates are moving. So the rates are dropping, borrowers are very happy. And they're like, this is, it can be better than this. This is really good news. Who knows whether it's going to even drop even more. That's every borrower's prayer. But how is product availability faring? So while the rates are moving in the right direction for borrowers, product availability, unfortunately, are moving in the opposite direction for borrowers. So mortgage accessibility has been impacted by 2 factors. The 2 factors that have impacted mortgage availability in this COVID-19 season is product availability and the stricter criteria by lenders. So the criteria by lenders to lend is becoming stricter in this COVID-19 season, and products are becoming, less and less available. So more and more products are being withdrawn from the market by lenders in this season, and as they withdraw those products, as fewer products become available, the criteria to access the mortgages become stricter. In fact, in this week alone, about 3 lenders, I think Accord Mortgages and Virgin, the likes of Virgin, have pulled out of their 90% loan to value product. They pulled their 90% loan to value products out after actually relaunching themselves into that market. They pulled those products off because the demand was just enormous. They couldn't handle it. And this is nothing else but shortage in operational capacity. So a lot of lenders are focusing more on dealing with existing customers, and the requests they're getting for mortgage holidays and mortgage holiday extension and all that is just, they are being snowed under by those requests, and they are focusing more on supporting their current mortgage customers than being very keen on taking on new mortgage applications. So if they're going to take on those new mortgage applications, they're going to make sure it is worth their time. They're going to make sure it is watertight. They're going to make sure it's viable enough, and they are going to make sure they're not overexposing themselves risk-wise. Okay, so these things are what lenders are considering before they launch back products into the market. So there is shortage of mortgage products. So overall, there has been a 40% drop in product availability from pre-lockdown levels. So before the lockdown, there were over about 4,485 mortgage products in the market. As at now, there are just about 2,695 mortgage products in the market. So 40% drop in the availability of mortgage products in the market. Now, some lenders try to come back and return to the high loan to value market, like 90% loan to value and 95% loan to value market. And like I mentioned, they just saw that the demand was just enormous. They couldn't handle it, and they pulled those products back again. So there are few 90% or high loan to value products in the market at the moment. If you've tried getting a mortgage within that loan to value, you'll understand what I'm saying. Even if you find them, the criteria are very strict. So they had to withdraw because they couldn't handle the demand. So lack of operational capacity has been the main reason behind the pulling out of these lenders from this high loan to value markets. Because remember, a lot of their staff have had to work from home. They've had to decongest the offices to make sure even those in the offices that are maintaining social distancing rules. So it's taking a lot of time, a longer time to process things now because of that lack of operational capacity. So it's basically focused on supporting existing customers. Okay, so that's the first update I've got for you. The second update that we're going to look at now is the reports that came out from the Bank of England on the lending statistics. So it shows that quarter on quarter lending has dropped by 10%. So the statistic for the first quarter of the year has been released by the Bank of England, and now we're looking at how that statistics, what's the implication of those excuse me, statistics on lending and on mortgages. So the revelation from there is that quarter on quarter basis, like from the last quarter of 2019 compared to the first quarter of this year, lending levels have dropped by 10% according to the figures from the Bank of England. So the value of new mortgages dropped from £73.4 billion as at last quarter of 2019, Q4 of 2019, to £65.8 billion in the first quarter. Okay, but if you compare it year on year, like the first quarter of this year compared to the first quarter of last year, there was actually a 3.8% increase in mortgage, value of mortgage lending. So which means even though the lockdown came in in the middle of March or towards the end of March. Up to the end of March, when you aggregate all the lending that happened within that first quarter, there was still a 3.8% increase compared to this time, same time last year, the first quarter of last year. But if you compare it quarter on quarter, last quarter of last year, 2019, there's been a 10% drop. So those are the two bases of comparison that has produced this result. Now, another key statistic in these figures is about the commitment to lending. Now, these are lending commitments that lenders have made over the next couple of months, right? Like when they issue out mortgage offers, and those mortgage offers show, you can complete on those mortgages, say in the next, you have up to 3 months or they're about to complete on those mortgages. So those are commitments that were made to lending. So that's an important key statistic that came out in this figure. So it shows that there has been a 4.3% drop in the lending commitments quarter on quarter. So compared to last quarter of last year to first quarter of this year, there has been a 4.3% drop in that. But if you compare that to first quarter of last year, there's actually been a 6.1% increase. So the mortgage commitments or the lending commitments dropped from 70.6 billion pounds last quarter of last year to 67.6 billion pounds first quarter of this year. But if you compare the same figure, if you compare the same statistic with that of last year, this time last year, first quarter of last year, there has been an increase actually of 6.1%. So that again tells you that this, in the first quarter, there has actually been an improvement, an increase, even with the lockdown that happened towards the end of March. Now, mortgages with high loan-to-value ratios, like 90% loan-to-value ratios and up to 90% loan-to-value ratios, there was an increase of 0.7% in those mortgages, by 0.7% up to 5.2% compared to the same time last year. So you can see that almost on every area of comparison, the first quarter of this year, in terms of lending and mortgages, by lenders, there's been an increase, despite the lockdown coming in the first, within that first quarter. So, but there was no change when we compare buy-to-let mortgages and the proportion of the total mortgages that were advanced, the proportion of buy-to-let mortgage to the total mortgage that was advanced, there was no change. It was still at 14%. So as at first quarter of last year, the proportion of buy-to-let mortgages that made up the total mortgage advance was 14%. And we saw the same thing, happen in the first quarter of this year. So there was no change actually. It still means that by the first quarter of this year, the proportion of buy-to-let mortgages that made up the total mortgage advance was still at 14%. So what does this data really tell us? It relates to the period when the full impact of COVID-19 has not been fully felt. So in the first quarter of this year, we haven't really felt the full force of COVID-19 because the lockdown just came in, I think on the 20th of March or towards the third week of March. And then within that time, the full impact of COVID hasn't been felt. So that's why we are seeing these differences in positive regions of comparing what's happened in the mortgage market in the first quarter of this year and what's happened in the first quarter of last year. So it's an indication of how well the market was doing before Mr. Lockdown came upon us. So if the gross mortgage advances was increasing compared to that of last year, first quarter of last year, it just shows that there was a steady increase. There was appetite to lend. There was appetite to borrow as well from borrowers. So the mortgage market was really thriving. The property market was thriving. Lenders were lending, and the total mortgage advances was really increasing until lockdown came in. So it makes you think or realize what would have become of the mortgage or property market if lockdown did not happen. So with some other lenders pulling out their high loan to value products from the market, despite them just coming to the market because of high demand, not really because there was no demand. You see, that's the difference. Some lenders pull, some companies pull their products out of the market because there's no demand for them. But in this case, the moment these lenders launched their 90% loan to value products, they were inundated by requests and by applications that they were overwhelmed. They just pulled it up. I was like, I wasn't expecting this. So it shows that the demand is there. It's just the products that's the borrowers are lacking. It's the product are not there, but the demand is there, the appetite is there. People are willing to borrow to buy and invest in properties or to buy properties. So lenders really have to find a way of coming back into those high loan to value markets, because the products in the market now really require, you don't find too many high loan to value products in the market at the moment, which really doesn't bode well for the industry. So we really need the lenders to come back into hi Hollins, good afternoon, thanks for coming on. We really need the lenders to come back into those high loan to value markets and offer people product options. Okay, so there is almost certainly going to be a significant drop by the time the second quarter results or the second quarter figure comes out. There's almost certainly going to be a significant drop in the number of people that are taking out high loan to value products, not because the demand is not there, but simply because the products are not there. Okay, and the fact that buy to let mortgages still made up 14% of total mortgages that was advanced in the first quarter shows you that there's resilience among the property investors. Because what property investors have gone through, and the kind of changes, regulatory changes and tax changes that have happened since 2017 till now, you would expect that there will be serious disinterest by buy-to-let investors in property industry. For example, the changes in mortgage interest relief, right? In fact, as at April 2020, mortgage buy-to-let investors, property investors are no longer able to claim back interest tax relief on the interest they have paid on their mortgages. They can no longer claim back tax relief on the interest they have paid on their mortgages. This policy started as far back as 2017, when the tax relief changes came in, and from 2017, the government was removing 25% of that relief each year. And by April 2020, every interest that you have paid on your mortgage as a buy-to-let investor, if the property is in your name, you cannot claim it back when you are doing your tax returns. So you're paying 100% tax on that interest that you've paid. So what buy-to-let investors have done, they have adjusted their businesses and tried to align their portfolio to, to be in line with what is tax-friendly for them. A lot of them have decided to, set up SPVs, and, coincidentally, we're going to be talking about SPVs today. To set up SPVs, special purpose vehicles or limited companies, and then they have wrapped their property investments in those SPVs and those vehicles so that they can mitigate the effects of these tax changes and these regulatory changes on their income and their investments. Unfortunately, it's not that easy to transfer what you have, the properties you have in your name, into the SPVs. There are tax implications, there are capital gains tax implications, there are issues that you have to consider, and you have to be sure it's really, really viable for you to do that. So with all those changes coming in, but it's still encouraging that there has been no changes in the total number of in the proportion of mortgage advances that buy-to-let mortgages have made up. So now let's talk about our topic today, which is on the different types of borrowers. Today we're going to be focusing on SPVs. We've got just a very short time to go through this, but let's see what we can achieve within this short time. So SPVs, what are SPVs? They are simply special purpose vehicles. Yeah, like the name implies, they are special purpose vehicles. So it's a vehicle, it's a structure that is set up as a conduit to enable a particular investment, a particular activity to pass through that vehicle. So it's a structure that is set up. So simply put, special purpose vehicles are limited companies that are set up for special purposes. And in this case, that special purpose has to be for properties. Yeah, so special purpose vehicles are a structure. They are just like your normal limited. There is no magic in setting them up. The way you set up your limited company on Companies House is the same way you set up the special purpose vehicles. The only difference is that this particular company is going to be specially set up for property investments. That's why it's special purpose vehicle. And while you are setting that up on Companies House, your specification code has to reflect what the company is set up for. So you might want to look at the real estate sector when you are the purpose or what the company does. You might want to look at the real estate sector and choose business activities that matches that. So it has to show that this company is investing in properties or is buying and letting their own properties or buying and letting properties for others as estate agents. So whatever category fits what you are setting it up for, choose that category while you're setting the company up on Companies House. So it's simply a limited company set up for the purpose of property investments or property activities. So the shareholders in the SPV are the people that control the SPV. So they can buy and sell shares in the SPV and they are not responsible for the debts owed by the SPV. So there's a separation. It's a separate legal entity. There's a separation from this structure and its owners. Its owners are different. They're only limited by shares. So their liabilities in that company is only limited by the amount of shares that they have in that company. So they control the shares. They can buy and sell the shares of the SPV. They own the SPV, but they don't own the property that the SPV owns. So the SPV owns the property, but the shareholders own the SPV. So like any other limited company, their liabilities are limited to the proportion of shareholding that they have in that company. So if, for example, 3 people came together to set up an SPV to invest in properties, and the contribution of their shares is 30, 30, 40. So if there is any liability in that company, the same thing goes with profits. If there's any profit generated in the company, in that SPV, they share it in proportion of their shareholding. The same way, if there's any liability, their liability is only limited to the proportion of shareholding that they have, meaning that they are immune, their personal assets are immune from any legal actions that has to do with the company. You cannot touch their personal assets because their liabilities are only limited to the shares they have in the company. Okay, so it's a separate legal entity. The SPV owns the property, but the shareholders own the SPV. Now there are situations where you go to apply for a mortgage on behalf of an SPV, or an SPV goes to apply for a mortgage. It doesn't mean that without setting up an SPV, you cannot apply for a mortgage as a limited company. Any other limited company trading in anything else can apply for a mortgage as a limited company. But lenders prefer to lend to SPVs rather than just normal limited companies that are engaged or involved in other business activities. The reason being that the risk to them of other normal limited companies is higher than the risk that the SPV is posed to them, because with the SPV, they know that it is all based on this property activity. And we have assessed the property activity, and this property is viable. So if the SPV carries on doing this property business, it's going to remain viable. And the assets in that company are just the property assets. So if push comes to shove, we get the asset back, liquidate it, and get our money before we dissolve the SPV. But then when you compare that with normal limited companies, say you have a limited company that sells cars, and you want to use that limited company to buy properties and invest in properties, and you want to use to borrow money from the bank to lend you money as a limited company to invest in properties. While some banks, some lenders will do that, some will not. A good majority of them will not. The reason being that in that your car dealership business, if anything happens and you happen to, say the whole car in your workshop, the workshop catches fire and the whole car burns to the ground, the business goes, it goes out of business. And then funds coming in there is no way they can actually tell how viable the business is. So if anything happens to that part of the other part of that business, it can affect the whole business, and therefore it can affect the interest of the lender who has lent you that money to do the business. Okay, so they are really skeptical about lending to limited companies that are not SPVs. Like I said, there are lenders out there who will still lend to normal limited companies. You can set up a limited company today and use it to borrow money tomorrow to invest in properties, as long as you meet the minimum deposit requirements and other requirements that they deserve. So it doesn't matter how long the business has been trading for. So back to SPVs. So the SPV will now go and apply for loan from the bank to lend them money to buy this property and to hold these assets in the SPV. So the SPV is therefore registered as the legal owner of the property. Right? That's very, very important. The legal owner of the property is the SPV, not the directors. Hi, Oge. Good afternoon. Hi, Emmanuel. Good afternoon. Thanks for coming on, guys. So they are the owners of the company. So the directors will ensure that all legal obligations of the company is complied with, and they meet with it. Okay, so the directors, they run the company on day-to-day basis, and all legal obligations are met. But the ownership of the assets, the property we're talking about, belongs to the SPV. So the people who should have owned the property, which is the shareholders of the SPV and the directors, they own the company, but they don't own the property or the assets in there. Now, the reason there has been a significant increase in the number of people registering SPVs and limited companies to invest in properties because of the tax changes, especially that came in 2007, which I have explained before, but I'm going to explain better now. So the difference in that now is, if you bought that property in your name, right, you have lost the interest tax relief on the interest rates. So if, for example, the total income from the property investment in a year is £10,000, and out of that £10,000, £9,000 was interest. Before now, pre-2017, that £9,000 will not be taxed. The only thing that will be taxed will be the £1,000 that is left after you have deducted the interest you've paid on that. 2017, the government took off 25%. So you are taxed on 75% of it. Sorry, you are not taxed on 75% of it. You are taxed on 25% of it. 2018-19, they took away 25%, reduced it to 50%. 2019-20, they took away 25%, and you are left with only 25% tax relief. 2020 April, the remaining 25% has been taken off. So you are now taxed on 100% of the interest. So the whole £9,000, you're going to pay tax on it if the property investment was in your name. Okay? Now, compared to if you bought that property in a company name or through an SPV, those interests that you have paid can actually be deducted from your company tax accounts. Right? They are tax deductible elements when you're doing your accounts. So you can see why it is, some investors find it more profitable. So if you have up to 4 properties, I would advise that anything from, even if you have bought properties in your name before, talk to your accountant, find out what the tax advantages are. I'm not an accountant, so I'm not advising you on account, but I'm just telling you some of the implications and reasons why people are doing what they are doing. I'm not saying that everybody's circumstance and situation is the same thing, and what fits this person might not be suitable for this person, because these things have their own pros and cons. But Some people found it more useful and more tax friendly and more tax efficient to own them in limited companies. That's why there has been a significant increase in limited companies that are registered since 2017 for property purposes. Okay, so again, tax implication. If you're a basic rate taxpayer at 20%, it may not really affect you that much. But if you're a higher rate taxpayer, like 40 or 45%, it may affect you, because the tax implications of that interest and the income you're paying, if you put it in an SPV, the corporation tax, which the SPV pays, was reduced from 20% to 19% and then to 17%. So it currently stands at 17%. So you can see that the company, excuse me, the company pays less tax at 17% than you pay as an individual, even as a basic rate taxpayer at 20%. Talk more if you're paying at 40 or 45%. So depending on the tax threshold you find yourself in, it might be beneficial for you to set up an SPV and use that to invest and buy your properties. So my interest in this is to show you how lenders react and the relationship between SPVs and lending as far as mortgage business is concerned. So the lenders will look at the directors and they will assess the directors. So because it's a company doesn't mean that they do not carry out any assessment of directors. They will assess the directors. If the directors have any financial issues, it might affect the lending decision, right? Again, some lenders might request for personal guarantees from the directors, meaning that they will ask you as a director of the SPV to guarantee that loan. So if the company doesn't pay, they come after you. Yeah? So some lenders ask for personal guarantees. Not all lenders do. Some do not ask for personal guarantee, but some do. Just like they would do for normal limited company loans or business loans. They will ask for personal guarantees in some cases. So those are the things that you also have to consider. So it may not be completely distanced from that liability. If you have given a personal guarantee, what you are saying to the lender is that if the company doesn't pay, come after me, I will pay from my pocket or my asset will pay. So lenders use the personal guarantee thing to give themselves that double protection that, hey, we're not losing you completely. The company is responsible, but you are also equally responsible. So bear that in mind when you are going to sign for that mortgage. Make sure that you understand whether there's a personal guarantee or not on that. So folks, that's the much that time would allow us today, and I hope it's been very useful to you today, and we've been able to teach you a few things today. If you found it useful, please let us know what you think, what you feel. Leave us a comment and tell us what you would expect from us. We are very open to suggestions, to opinions, and we're very open to corrections as well, as long as they are constructive, and criticisms are welcome as well, as long as they are constructive, because the reason we are here is because of you. So if you're not finding value in what we are doing, please let us know and tell us what you find value in, and we'll bring you that. So have a wonderful day. Enjoy the rest of your day. Thank you very much for being here, and I'll see you again next week. Remember, on Mondays we do our Modesty's Money Masterclass on Mondays, and on Wednesdays we do our Modesty's Mortgage Masterclass. Okay? And this episode will be very much available on YouTube. So if you want to watch other episodes and what we've talked and what we've done in the past, go to my YouTube channel. Just search Iken Naumezudike on YouTube, and my YouTube channel is there. You can watch all the backlogs of episodes that you've missed, and we keep updating that YouTube. If you subscribe to our channel, you'll be the first to know when we upload new contents on YouTube. Thank you very much. God bless you, and take care. Bye now.